So yesterday we started a discussion about terms of trade, but we could not complete it, right? So we'll continue from here today, right? Okay, so what is terms of trade, right? Now, if you remember, I told you that it's a formula that captures the relationship between export prices and import prices, right? So you can say this, it is a formula, right? Slash calculation that measures change in, I'll show you how is that the case, right? That measures, uh, not really change, but forget about it. Now, it's a formula calculation that measures countries' export and import prices, right? Now think about this. So the idea is that when countries engage in international trade, they're always concerned about their export and import prices. Why? Let's talk about this first, right? So your export prices mean, I mean, it's not revenue. Now, students, first of all, have a look at this. It's a formula that captures a country's, it's a formula calculation that shows, that records, right? I mean, this is a little difficult, that records a country's export and import prices. Now think about this. So the idea is whenever countries engage in international trade, they're always worried about their export and import prices. Why? I mean, it's not revenue. Let me remind you first of all, right? So what's revenue? Just to get the basics clear, students. So revenue is the total amount that you receive from the receipt, from the sale of any product. So revenue is basically price per unit into quantity, right? So we're not talking about revenue at the moment. Since a lot of students get this confused, that's why I'm clearing this up early on, right? Now, when you multiply price of each unit of the good with its quantity that you're selling, that's what your revenue is, right? When we record exports and balance of payments, my question to you is, when we record exports and balance of payments, do we record prices or do we record quantities or do we record revenue? When we record exports and imports and a balance of payments, which of the three things do we record? So that's my first question here, right? So which of the three variables do we record in our balance of payments, right? So we record, Zohan is saying quantity. What about other people? What do we record? In balance of payment, do you remember in current account, we had exports of goods and imports of goods, and similarly exports of services and imports of services, right? What do we record? Yeah, Khazir, Khadija? It's the revenue, students. It's the amount. Revenue meaning the dollar value, right? Let me write this down like this so that you can remember for the future, the dollar value, right? It's a monetary value that we record in our balance of payments, that how much worth of goods we sold, or, you know, how much worth of goods we bought, right? Goods, I mean, not only goods, but services as well. So that's what we're recording in our balance of payments. But be careful that in our terms of trade, we're not recording revenue. Instead, we are focusing on price of the products. We are focusing on price of the goods. Now have a look at this. So terms of trade is a calculation or a formula that records a country's exports and import prices, right? Now, apparently this sounds very simple, but it's not, because we'll go into the detail of this, that why terms of trade is important, what it actually shows, what factors affect countries' terms of trade and all these things, right? Now, terms of trade, which is also written as TOT, right? So it is basically index of export prices divided by index of import prices. Now, what we, started our discussion about yesterday, but we could not complete, and we'll complete it in today's class, that a country exports couple of products, right? Multiple products, simply speaking, right? So there is hardly any country in the world that exports one product. I mean, I don't think it's a very, it's very likely to happen, because obviously countries have to diversify. They can't rely on export of just one thing, right? So oftentimes, I mean, it's very obvious to understand that you need a couple of things. Therefore, you import those products, and similarly, you also try to export as many things as much you can. So there will be a couple of products that are being exported and imported. Okay, now think about this. Can we add the quantity? We can't add the quantity up, right? So we can't add, so it's there, therefore it's prices. So we can't add the quantity of clothes into the quantity of oranges, right? So apples and oranges can't be added, right? But the prices could be aggregated. But the prices of apples and oranges could be aggregated. Are you getting what I'm trying to say here, right? So the idea is, students, let me just Okay. Now, index of export prices divided by index of import prices. Now, first thing that you need to know is that what is an index? Index is an aggregate number without a unit. Let me write this down for you so that you can remember. So index is an aggregate number without any unit. And I'll explain you, don't worry about it. Index is an aggregate number without a unit. Okay. Now, if you think about anything, right? If you think about anything, most of the times it has a unit to it. So if I say, what's the temperature today, right? It has a unit to it. What's your weight? There's a unit for measuring weight. What's your height? There is a unit to measure that. What's your age, right? In terms of years, right? So everything has a unit, but index is a aggregate number without any unit. Right. All products. That's a very good question, Zohan. So Zohan asked that export prices include all goods and services. Yes, that is why. Yes, all goods and services. So think about this. If there are 100 products, now let me explain you like this. If there are 100 products that a country is exporting, so you will aggregate the prices of those 100 items, 100 products to find this value. To find this value, index of export prices, if there are 100 items, could be 1,000, could be million, I don't know. But index number would be a composite number that represent that how the prices changed over time. Now, I have a very good example and explain you, and that is totally related to economics, and this should be interesting for you all. Have you ever gotten the chance to look at how stock markets are evaluated, right? Now, let's say there's a New York Stock Exchange. I can also show you on the Google right now, but let's say there's a New York Stock Exchange, right? Now, what they say that today or in the last week or in the last month or in the last year, whatever the period is, that's not important. New York Stock Exchange gained, now focus on the wording. New York Stock Exchange gained 1,000 index points. Now you would be like, index points, okay, what is this, right? Now let me tell you what 1,000 index point means. That gained 1,000 index points. So just by the simple application of the language, you would understand that gained 1,000 points would mean that compared to before, this is 1,000 points more. Do I make sense or not, right? Let me say it again. So the wording says gained. New York Stock Exchange last week, let's specify if you're having confusion understanding. Last week, New York Stock Exchange gained 1,000 index points. Now gained means it's an addition to the already existing value. It's an addition to already existing value. Is everyone clear on this or not? Right, I'll tell you. Yes, Juan, exactly. Now students, it doesn't mean that each share has increased in value by $1,000. It doesn't mean that 1,000 more companies are now listed on the stock exchange. It doesn't mean that, the profit of the companies listed there have increased by, $1,000 or 1,000%. None of this. All it shows that the growth in New York Stock Exchange prices, stock prices. What does stock exchange has? Shares. What are we recording? Share prices, right? So if stock exchange is going up, that means share prices are going up. I mean, this much you would know. If you don't know this much, even that's not a problem. I can explain you in detail. Now, public limited companies across the globe are listed on their country's stock exchanges, public limited companies, right? Now, if you think of all these big companies that you would be aware of, Amazon, Google, Microsoft, Facebook, right? All of these are public limited companies. They're listed in New York Stock Exchange. Could be listed on other stock exchanges as well. But obviously these are American companies, so they are definitely listed on New York Stock Exchange, right? Now, the idea is by public meaning that anyone can buy the shares. So if today you want to buy the shares of Amazon, Facebook, Google, Microsoft, if you're willing to pay the price, you can buy the shares. I mean, it's as simple as that, right? That's why they are known as public, general public can buy shares, right? In Pakistan Stock Exchange, we have over 300 companies, if I'm not wrong, yeah, approximately 300 companies, right? So you can buy the shares of those companies in Pakistan. And so on and so forth. Okay, now gain 1,000, and what does it record? Yeah, that was what I was explaining you. So it lists public limited companies and listed on stock exchange And stock exchange shows the changes in prices of these stocks. What does stock even mean? So stock or share is basically, back in the day, it used to be a piece of certificate. Back in the day, a stock or share used to be a piece of certificate that showed a person's ownership in a company. Now listen to this very carefully, students. Back in the day, it used to be a piece of paper, a certificate kind of a thing, just like you get when you clear your OA levels, that showed that Kasim or XYZ has 100 shares in Amazon, Facebook, or whatever XYZ. Okay, now this is my way of, this document, just like you have property documents, it shows that this person A holds 100 shares of the company. Okay, but over time everything became digital, right? Now you don't go and you take that certificate and give it to someone, take the money. So it's not like when you buy shares, you take a certificate, and when you sell shares, you give away the certificate. No, it doesn't happen like that. Everything is digital. Everything is monitored through apps, right? Web applications. So you go on their portal, stock exchange portal, you sell the shares or you buy the shares, right? So there's no transfer of physical documents. There's no transfer of physical documents. Am I making sense to you all? I hope it's not that complicated, right? Is this making sense? Right? Easy, good. Can you move on? No transfer of physical documents, right? Okay. Now it's just like when you transfer money from your bank to someone else's bank. So when I'm sitting on my laptop, I open my bank application, I transfer 1,000 rupees to someone else. So in my account, it will show 1,000 less, whatever it was previously. Now it will be 1,000 less. And that other person who received my amount would have 1,000 rupees more, right? Simple. No physical transfer of cash. So my bank would not take 1,000 rupee note and go and deposit it in the other bank. No, it doesn't happen like that, right? Easy. Same is the way of stock exchange. Now, stock exchange lists prices. What does it show? It shows prices of shares. Shares or stock is the same thing, by the way, right? Shows prices of shares of the companies listed on stock exchange. Easy. Any confusion so far? Any confusion so far, right? Companies listed on stock exchange, right? Okay. On stock exchange. Okay. Now, on a certain day, now this is the most important thing, students. Now you have to listen to this carefully, and then if you have any follow-up questions, I'll be happy to answer all of those. On a certain day, just think about Pakistan Stock Exchange, because I mean, 300 companies relatively. I mean, you can imagine any stock exchange doesn't make any difference, but still, out of 300 companies on Pakistan Stock Exchange, do you expect the prices to move exactly the same manner? So if, let's say, on Pakistan Stock Exchange, we have Pakistan State Oil listed, and then we have, another electricity company listed, and then we have another company listed that manufactures fertilizers or cement or whatever. Do you expect that the prices of their shares of these 300 different companies will move in the same direction by the same amount every day? What do you think? And if you are confused that how share prices move, so the answer is simple: demand and supply, right? Now, if for those of you who don't have a background, right, who don't have much knowledge, just to tell you, think about this. How many people, what determines the price of any commodity? Commodity could be anything. It doesn't necessarily need to be a useful product. Commodity is anything, right? I mean, if you're buying some antique, which is just a decoration piece, that's also a commodity, right? Now, in economics, any commodity's value is determined based on its demand and supply. So if people are anticipating that, Tesla, Elon Musk is going to do something big in the coming future, what would people do? I want everyone to submit their individual answers. If there's a company, think about Facebook. You might be more aware about Facebook. So if people are anticipating that Facebook in the coming years is about to do something big, right, with which the profits of Facebook will go up, right? How do you expect investors to respond to this information? Would they buy more shares of Facebook, less shares of Facebook? Will they sell more? They will buy more, demand more, what? People will buy more shares. Khadija, are you following me? Because people want to take ownership of the company that is about to become more profitable. Because in future, when the company becomes more profitable, you will get more return on it. The share price will go up, right? So if you bought a share for 100 rupees in Facebook back in the day, now it's worth 150 rupees or dollars or whatever, right? So you gained 50 rupees or $50 on that one share. Yes or no? Is this making sense, right? So when the demand for a share increases, its price goes up. And when the supply increases because people are trying to sell it, right? Because they're saying that, it's not that profitable or whatever the reasons might be, right? So the price goes down. Simple, demand supply, what we know always, right? Easy, very good, excellent. Now coming back to where it all started from. Now, on a certain day, you don't expect 300 companies' share prices to move in the same direction. And even if it's moving in the same direction, the magnitude of change would be different. Some shares might grow by 10%, some shares might grow by 30%. Okay, now that presents us a problem. Students, listen to this very carefully. Now that presents us a problem because if you have to analyze Pakistan Stock Exchange overall performance, what would you do? I mean, 300 companies, shares moved in different directions. Some shares increased in value, some shares decreased in value, some shares increased by more percentage, some shares value increased by less percentage, or some shares prices even decreased. Now, how can we come up with some value or number that could show the overall change in the market? Overall change in the market. Are you getting me? That is where the index number comes into play. And similarly, think about this. Another example I can give you. Inflation. When we were calculating inflation, do you remember we calculated an index number? And then we used to calculate the percentage change in the index number to know what the rate of inflation is. Because during any time period in a country, some product prices will increase, some product prices will decrease. So you can't really tell what happened overall. And therefore, you need to calculate that index number. Students, are you following me? Still confused? Are you getting me? Right? Right? So index number, coming back to where it all started from. So we don't know what the starting value was. Let's say the starting value of New York Stock Exchange was 100,000 because that's the statement, right? Gained 1,000 index points last week, right? So if it started from 100,000 points initially, now it would be how much? It would be this much, previous and new. Do you agree with me? Right? So if the previous index number was 100,000, now with 1,000 index points gain, it will be 101,000. 101,000. Easy? Confused? What? What's confusing? Quickly. Yeah. Ask me. Khadija, Khizr, whatever questions you have, now is the time to ask me. Regarding obviously everything that we've discussed so far. Whatever we've discussed so far, if there are any questions, ask me. Right? Do you get it? Easy? Gain 1,000 index points, right? Okay. Now, what is the percentage change? Can anyone quickly calculate the percentage change in these two values? Calculate the percentage change in these values and then let me know. And then move forward. Right? I've already calculated. Yeah. What's the percentage change, students? So that was the previous index value. This is the new index value. Can you calculate the percentage change for me, right? How do we calculate the percentage change? Shouldn't be difficult, right? Let me see if you got the correct answer. Come on, Zohan, percentage change. Percentage change in the two values. You should not be making such mistakes, right? Think about this. What's the new index value? What's the new index value, students? The new index value is this much. What was the old index value? This much. New minus old divided by old. Am I right or not? Right? So that gives you 1,000 in the numerator. That gives you 100,000 in the denominator. So 3 zeros and times 100, obviously, right? So 3 zeros get cancelled out with 3 zeros. 100 divided by 100 is 1. So there's 1% increase. So there's 1% increase. Any confusion so far? Right? 1%, right? I mean, yeah, the way you were doing was right, but you should not have used the word, the symbol of percentage, right? Right? You got it? Okay. Now, this being said, students, are you getting? Okay. Now, 1% increase. This means, very important point I'm about to explain you. If the New York Stock Exchange last week, as per our example, last week, New York Stock Exchange gained 1,000 points. And this information was also provided to you that the starting index number was 100,000. This means when we calculated the new index value, that was 101,000, and it turned out to be 1% increase. This means that overall share prices of stocks or companies listed on New York Stock Exchange, their prices or their value increased by 1%. I repeat, it means that overall, right, on average, overall or on average, the share prices of the companies listed on New York Stock Exchange increased in value or increased in prices by 1%. But there will be a couple of companies in this value for which the share prices decreased, and there will be a couple of companies for which share prices increased more by 1%, and a couple of companies for which the share price increased by less than 1%. But it's an aggregate. It's an aggregate. So it's just like saying that when I say that inflation rate in Pakistan was 10%, if I say that inflation rate in Pakistan last month was 10%, does that mean that every product exactly increased by 10%? Let me ask you this question. So when you read in newspaper that last month Pakistan had 10% inflation rate, does that mean that all products in Pakistan, every product in Pakistan last month increased by 10%, exactly by 10% in prices? Does it mean that? Does it mean something else? What does it mean? No, exactly, right? It's an average because exactly on average, right? Because some products might have decreased in prices, some products might have increased more than 10, and some would have increased by less than 10. It's an overall, exactly. So you use index numbers when calculating inflation, you use index number when measuring the performance of stock exchange, you use index number when you are measuring the change in export and import prices like we are about to do in terms of trade, right? Now, is this giving you a more better perspective, right? Are we good on this? So index is an aggregate number without a unit, right? So there is no unit, right? Okay. Now, another important question that Zohan asked and I answered, does that include export prices of all products that are being exported? Yes. It includes export prices of all the products that a country exports. So if Pakistan exports 50 goods, then this value will include the prices of those 50 goods. If Pakistan exports 1,000 products, that would include the prices of all those 1,000 goods and so on. Similarly, all the products that a country imports, 1,000, 2,000, whatever, right? Their prices will be included in this value. Easy, good, okay. Now, why is this important, right? So let's first talk about why is this important and then move forward from there. So students, it is important because what? Yes, that's what we're coming to. It's important for a country to know that how its export prices performed in relation to its import prices. Now, this might sound a little, weird at first, but I'll explain you how is this important. So let's look at this one more time. So you have in the numerator index of export prices. So just to save ourselves some time, I'm not writing export. Instead, I'm using the symbol that we use in economics. So it's index of X prices, which is exports, divided by index of M prices, excuse me, which is import, right? Okay. Now, the idea is, think about this, students. Exports are getting you what? What do exports get you? Foreign exchange, right? When you sell your products to other countries, what do you get? Foreign exchange, right? Which is precious for a country. Yes or no, right? Another, right? The which is precious for a country, right? Yes or no? Then if you export more compared to imports, what does that do? That brings you surplus on your foreign exchange. But be careful what I'm saying. If your export value, the value of your exports is greater than the value of your imports, then there is a surplus on your trade in goods. Then there is a surplus, perhaps not on overall balance of payments, but that would definitely be a surplus on trade in goods. Are you guys following me or not? Trade in goods. Yes or no? Easy? right? Or trade in services or whatever it is, right? Now, the idea is, okay, think about this. I was saying that why exports are important for a country. I'm just talking about that for a minute. Exports get you foreign exchange. That's why exports are important. Secondly, if the value of exports is greater than the value of your imports, that's a surplus which is beneficial for a country, because again, foreign exchange comes in and so on, right? Yes or no? Okay. And imports are a burden on the economy, right? So imports should technically be sponsored from your, now listen to this very carefully, students. Imports should be sponsored. Do you understand what the word sponsored mean? Should be sponsored through your export earnings. Should be sponsored through your export earnings. Now, what I simply mean that if a country is out of balance, right? If a country is out of balance in the sense that it's exporting too little and it's importing too much, knowing the balance of payments idea, do you think it's a burden on the economy? I'm coming to, we will address this question. That's a good question. We will address that. But for now, just think about this. If a country is constantly importing more, like the value, now I'm talking about the value, I'm not talking about the prices only. If a country is exporting more, the value, sorry, if a country is importing more, the value of imports is greater than the value of exports. Do you think that will be a problem for a country? What will that do? That will cause your balance of payments to go into deficit, for which you will need to borrow money from IMF, or you will need to use your foreign currency reserves, all the things that we discussed in the balance of payments, uh, all the things that we discussed in our balance of payments, right? Let me repeat this one more time. So imports of a country should be sponsored through country's exports, which means what? That if you're exporting, let's simplify this. Let's not use fancy wording. If a country is exporting goods 100 million and you are also importing 100 million. So these are your exports and your imports are also exactly 100 million, let's assume. So that's not a problem, because whatever foreign exchange you earn, if that foreign exchange is spent back on buying the goods that you need, I mean, your foreign currency reserves will neither increase nor deplete. I repeat, when a country is exporting goods worth $100 million and the country is also importing goods worth $100 million, then technically you have been able to sponsor your imports through your exports, right? Because your foreign currency reserves are not increasing, right? Because all the money that you earned in foreign exchange was spent buying your imports, but at least you did not go into deficit. Yes or no? Right? Right? Okay. Now, Zon, just stay with me. On the other hand, if your exports would have been something less, if your exports would have been 50 million and your imports are 100 million, now what does that require? You will use, either you will need to take a loan in if deficit is not persistent, like if it's not constant, you might not need to take a loan. But if the deficit is persistent, I did tell you, right? So if a country constantly faces deficit, meaning more imports and less exports, then there will come a time when you need to borrow money from IMF, International Monetary Fund, to sponsor your imports. Are you getting me? Right? So if it's a one-time thing, not a problem. It will only deplete your foreign currency reserves. You exported goods worth 50 million, you imported goods worth 100 million. So your foreign currency reserves will deplete by 50 million, right? But if you are constantly in a situation of a deficit, that's a difficult situation to be in, right? Because then it means that you would need to borrow money from the IMF. Easy? We good on this, right? Now, coming back to the point, foreign currency, borrowing is always in the foreign currency. Most of the times it's in dollars, because dollar is the strongest currency, dollars. When you borrow from IMF, World Bank, it's in dollars, right, John? Okay. because your own currency, you can print more of your own currency any day, right? Why would they take money which has uncertain value? They will give you loan in their own currency, right? Are you getting me? That's how it works. Okay. Now coming back to the point. So terms of trade shows how much stronger are your exports prices compared to your import prices. Basically, it shows that how much more exports or how much less exports you need to do to support your imports. Now, this is again a difficult language. Let me put it like this. So have a look at this, students. Now, this is a very important thing that we're about to do, and everything will become crystal clear. Now, if your exports were, now we are talking about terms of trade, export prices, right? So export prices start of year, end of year, right? So all we are doing, and similarly, we are recording import prices, start of year, end of year, right? Okay, now think about this. So here you go. Start of year, end of year. End of year. Okay, now think about this. I'm giving you some calculations. If you have a calculator, that would be really helpful, right? Right. And let's say 750. So calculate the terms of trade at the start of the year. What was the terms of trade? Right. So what was your, and this is index. Sorry if I did not mention this, right? So it was index of export prices. This is not just export prices. This is like aggregate, what we need to calculate the terms of trade. And this is also index of import prices, right? 2, right? And what's your index, what's your terms of trade at the end of the year? That's also 2. 1500 divided by 750 is 2, right? If I now modify this example a little bit, and instead of 750, I say it's 600. Now, can you tell me that whether your terms of trade improved or whether your terms of trade deteriorated? Now, what's the language we are using here, students? So if your terms of trade overall is increasing in value, if your terms of trade is overall increasing in value, that's known as improved, right? And if it's overall decreasing in value, that's known as deteriorated. Deteriorated, right? Now you can tell just by looking at the values, it improved. Now it is 2.5 or whatever, right? Now, what's the idea? Now, if you look at this example, compared to the start of the year, listen to this carefully. Talking about this example, compared to the start of the year, now you need to export lesser quantity to sponsor your imports. I repeat, compared to the start of the year, now a country needs to export lesser quantity to sponsor the same quantity of imports as it was doing at the start of the year. Do you agree with me or do you not? Compared to the start of the year, at the end of a year, a country needs to export lesser quantity to sponsor the same quantity of imports that it was doing at the start of the year. Is it technical? Is it difficult? Right. Think of this example, 100 million, 100 million, right? So at the start of the year, let's say you were exactly balanced, right? Both were 100 million, right? But at the end of the year, what happened? Your export prices increased. Your export prices increased, right? Now, this means that even if you export lesser quantity, right? Since prices are higher, even if you export lesser quantity, you can still earn the same amount of revenue. Who can tell me if they got this or not? Given rising prices, if you have to achieve a target of 100 million, and this is increasing, right? So even if this decreases, you can maintain that revenue. If I'm using the word if, would that happen? Would that not happen? That's a different story altogether. Just tell me mathematically. All what we're doing here is maths. If a country wants to achieve 100 million exports, right? Why? Because it also has 100 million imports. So it wants to pay for its imports through its exports. If a country wants to achieve $100 million of exports because it wants to pay for its imports, right? And imports are fixed at $100 million. And now if the export prices are increasing, then technically, even if you sell lesser quantity, you can still achieve, right? If let's say price is increasing quantity, if you sell lesser quantity, you will still achieve same revenue. Do you agree? That when the value was 2 and at the end of the year export price increased by 0.5, so if we export lower amount of export, we will be able to maintain to balance our revenue. Exactly. That's what I mean. Zuhan, no, sorry, Khizr, Khadija, did you guys get this part or not? Now, just think of this like this. You have to achieve a target of 100 million because your imports are also 100 million and you want to, right, balance the two things out. Now, if your exports are becoming expensive, if your export prices are increasing, as I just showed you in the example, right? If your export prices are increasing, then you can afford to sell lesser quantity. You can afford to sell lesser quantity because price is increasing. So now when you multiply a bigger value with even a smaller value, you can still maintain the same value on the other side. Yes or no? I mean, for now, don't think about it. It can happen. It can happen. But this is not what we are recording here. It can happen. Forget about, right? So if goods are getting expensive, the quantity would decrease. Forget about it. But technically, mathematically speaking, right, you can export even lesser quantity so that you get to maintain your balance. Is making sense or not? So what it implies that a country has better or stronger position in international trade. Let's put it down in simple words now. Oil is becoming expensive because Russia has stopped supplying, right? Let's say oil is becoming expensive for whatever reason. So there are two countries. One is exporting oil and one is importing oil. Which will be on the gaining end, which will be on the losing end? There's only one product I've given you the example for. So there are only two countries in the world. There's only one commodity, right? And oil prices are increasing. So one is exporting, one is importing, which become prices of oil are increasing. Which country is in stronger position and which country is in weaker position? Simple. Yeah, right, exactly. So the country that is exporting oil will be in stronger position because the product that you export is becoming more expensive. Will people stop using, will countries stop buying oil? It's a different thing altogether, guys. Don't confuse it for now. Right, exactly. So the country, when any product becomes expensive and you are the exporting country, so you like it. Yes or no? If you are the country that's selling a thing and your export prices are going up, you like it because now you are in a stronger position, right? Are you getting me? What are the complications involved? What are the other factors that need to be concerned, to be considered? We'll talk about all of that later on. And if imports are increasing in prices, right, for your imports, the product that you're importing are becoming more expensive, you don't like it because that's burden. Now you have to pay more to buy the same things, right? It's just like what you sell and what you buy. What you sell are your exports. So if they are increasing in value, you like it. The things that you buy are your imports. And if they are increasing in value, you don't like it because now you have to pay more. It's as simple as that. Easy. So the class is about to end. I'll take 5 more minutes just to wrap this up and then we'll continue the rest tomorrow. But do join with the link. I'll just take 4 minutes more.